Welcome. Settle in wherever you are. If you're lying down, good. If there's a blanket nearby, now's probably the time for it. Take a breath and let it go. Tonight we're going to move through one of the longest, strangest stories in human history. The story of money. Where it came from, what it went through, what it became, and what it might still be turning into. Because that part genuinely isn't finished. It stretches back thousands of years before anyone wrote anything down, through river valleys and dusty plains, through temples and market squares and lamp-lit counting houses. And it reaches all the way forward to the screen you might be holding right now, or the one on the table beside you. Not every detail needs to land. Some of it will drift in, some of it will drift past. Both are fine. So, let's go back. All the way back. Long before there was money, there was simply need. Someone woke up and needed to eat, needed shelter from the cold, tools, warmth, company. In the earliest human communities, meeting those needs was direct. You made what you could, gathered what the land offered, and when you had more of something than you needed, you shared it. That was the first economy, or something close to it. It didn't have a name. No one called it anything. It was just the rhythm of people living close together, sharing what they had, trusting, without quite deciding to trust, that the sharing would come back around. Anthropologists who've spent time with evidence of these early communities have found something that might seem surprising. They didn't really operate on strict individual exchange. Not a ledger, no column for what you owed and what you were owed. There was something looser, a general pool of goodwill, an unspoken web of obligation and generosity that held the group together from season to season. If you helped someone build a shelter, they didn't hand you something in return that afternoon, but the gesture was held, remembered. That's how it functioned. The memory of generosity, distributed across the whole group. This is sometimes called a gift economy. And in a lot of ways, it's the oldest arrangement we know of. It required real trust. People had to actually know each other. Not just recognize each other, but know each other. And it worked well in small groups, precisely because everyone's reputation was visible. You could see who contributed and who didn't. The group was legible to itself. For perhaps most of human history, that was enough. Small groups, moving with the seasons, living inside a net of mutual care that didn't need a name or a rule. There's something genuinely restful in that picture. But over thousands of years, things shifted. Settlements grew larger. People stopped moving and started farming. Villages became towns. And as communities expanded, that intimate web of personal knowledge became harder to maintain. Actually impossible beyond a certain size. When you live with 20 people, you know them. You know who is generous, who can be relied on, who quietly takes a little more than their share. The gift economy works because the whole group is visible to itself. At 200 people, that starts to fail. At 2,000, it's gone. What happened next wasn't sudden. No one called a meeting. There was no announcement. It crept forward over generations, probably without anyone noticing while it was happening. A slow drift from generosity to accounting, from trust as feeling to trust as record. One of the most consequential shifts in human social life. And it happened quietly, without fanfare. The first step was barter, direct exchange. You have grain, I have fish. We each want what the other has, so we trade. It sounds simple. And across early agricultural communities, in Mesopotamia, along the Nile, in the Indus Valley, it was woven into everyday life. Grain for pottery, cattle for cloth, labor for food, real and meaningful exchanges, the threads of daily commerce. But barter has a famous problem. Economists call it the double coincidence of want, which is a dry name for a very human frustration. For a barter transaction to work, both parties need to want exactly what the other has, at exactly the same time. You have grain and want fish. You need to find someone who specifically has fish and specifically wants grain. Not someone who wants pottery, not someone who wants your labor. Someone who wants grain, today, now. In a small village, this is manageable. You know who has fish. You walk over. But once trade routes stretched between distant places, once you were dealing with strangers who might want completely different things, the system started to creak. Picture traveling for days to a distant market with a cart of grain, only to find that the cloth merchants want copper, not grain, and the copper traders want something else entirely. No neat solution presents itself. It becomes a puzzle with too many pieces and no obvious way to match them. What everyone needed was something that anyone would accept. A bridge between all these different wants. Something whose value wasn't tied to what one particular person happened to need on a particular afternoon. A medium of exchange. The search for that medium turned out to lead early humans to some genuinely surprising places. All over the ancient world, objects were being used not for their direct practical value, but as tokens, stand-ins that everyone in a given community had agreed were worth something, real things with real practical uses, not abstract promises, actual objects people wanted to have. One of the earliest and most widespread was livestock, cattle specifically. In cultures across Africa, the Middle East and Europe, cattle were the original wealth. To be rich was to have many. To have none was to have nothing. And there was a certain logic to it. Cattle were universally desired. They produced milk and labor. They could be eaten, and they reproduced. Wealth that could literally grow overnight. The problem is that cattle are spectacularly awkward as a currency. They resist transport. They die. You cannot make change from a cow. If a loaf of bread costs 1/10 of a cow, you run into immediate difficulties. So alongside cattle, other things began to serve the purpose. Salt mattered enormously. To us it seems ordinary, something in a shaker on a table. In the ancient world, it was closer to a matter of life and death. It was the only reliable way to preserve food before refrigeration. Without it, meat spoiled, fish spoiled. A supply of salt was survival, not comfort. The word salary comes from the Latin word for salt. Roman soldiers were allegedly paid in it at some point. The evidence is actually debated, which is a bit strange given how often the story gets repeated. But the connection between salt and payment ran deep enough to enter the language permanently. In sub-Saharan Africa, compressed salt blocks circulated as currency for centuries, broken into smaller pieces for smaller transactions, universally desired, slow to spoil in dry climates. Then there are the rye stones of Yap in the Pacific Islands, which are worth pausing on because they make you think. These were large circular stones, sometimes enormous, too heavy to physically move. And yet they functioned as money. Everyone in the community knew who owned which stone. The stone didn't need to travel. The knowledge of ownership was enough. What that tells you is that money was always partly about agreement, not about the object itself. The stone had no intrinsic value. Its value came from a shared belief, a community-wide acceptance that it was worth something. Every form of money since has worked the same way. Every single one. Salt, cattle, shells, stones. Each one tells you something about the people who used it, about what they needed, about what they collectively chose to trust. And then, slowly, one kind of commodity began pulling ahead. Metal, precious metal specifically, gold and silver. The case for metal as money is almost embarrassingly logical once you line up the qualities. It doesn't rot, unlike grain. It doesn't die, unlike cattle. A piece of gold buried for 1,000 years comes out looking essentially the same. It's divisible. Melt it down, reshape it, lose nothing. Portable, dense enough that a small piece holds meaningful value. Scarce, it has to be mined and refined, which takes effort, and that effort is part of what gives it worth. There's a fifth quality that matters more than any of those. Metal is fungible. One piece of gold is, for practical purposes, the same as another piece of gold of equal weight and purity. You don't need to know the history of a particular coin. You just need to know what it is. That interchangeability is fundamental. If every unit of money is slightly different, every transaction requires negotiation. If all money of the same denomination is identical, exchange becomes automatic, almost frictionless. Gold and silver were filling this role long before anyone invented coins. In Mesopotamia and Egypt, traders were weighing out silver to settle debts thousands of years before the first coin was stamped. Every merchant carried scales. Value lived in the weight, not the shape, which worked. But it had an obvious inconvenience. Every transaction required weighing. Every weighing required trust, that the scales were accurate, that the metal was what it claimed to be. Unscrupulous traders shaved slivers off, mixed in cheaper metals. The system demanded constant vigilance from everyone, every time. What would remove that? Something that certified the quality and quantity in advance, that made the metal trustworthy at a glance, without needing to test it. A coin. Here is one of those rare moments where history lets us name a time and a place. Around 600 BCE, the kingdom of Lydia, in what is now Western Turkey. The Lydians lived in a region naturally rich in electrum, a naturally occurring alloy of gold and silver. And at some point, we don't know exactly when or whose idea it was, the Lydian kings began stamping small lumps of electrum with an official seal. A lion's head, the royal mark. The stamp was a guarantee. It said, in effect, this metal has been weighed and tested by royal authority. You can trust it without checking yourself. The king has done that part for you. Simple idea. The effects were enormous. A transaction that had required scales and metallurgical knowledge could be completed in moments. You saw the stamp, recognized the authority it represented, and knew what you held. Trust had been pressed into the object itself. The idea spread fast. Greek city-states adopted it with enthusiasm. Within a century or two, coinage was moving across the Mediterranean world and beyond. As it spread, people noticed that some currencies were more trusted than others. The coins of Athens, the famous owl on one side, the goddess Athena on the other, became particularly respected. Known for reliable purity, consistent weight, You could carry Athenian coins almost anywhere across the ancient Mediterranean and expect them to be accepted without question. Merchants in distant ports knew what an Athenian owl was worth and trusted it accordingly. A trusted currency, issued by a trusted authority, travels much further than its home. That pattern recurs throughout monetary history. The specific coins change. The principle doesn't. The ancient world built elaborate monetary systems, and they looked quite different from each other. In China, coinage developed independently at roughly the same time as Lydia, one of those historical parallels that makes you wonder how much is coincidence and how much is just the same problems producing the same solutions. Chinese coins were typically bronze rather than gold or silver, with a distinctive square hole in the center so they could be threaded on a cord. A string of 1,000 cash was a standard unit of value. You looped it over your shoulder and walked to market. Practical, actually. More practical than a pouch of loose coins in some ways. In India, small irregular pieces of silver appear from roughly the same era. Punch-marked coins stamped with symbols indicating origin and purity. In Persia, the Achaemenid Empire issued gold coins called the daric, named after Darius. These became a trusted medium of exchange across the Near East, carried by soldiers and merchants through an enormous swathe of the known world. And then, Rome. Rome built something that hadn't quite existed before, a genuinely integrated monetary economy across an empire, stretching from Britain in the north to Egypt in the south, Spain in the west to the edge of Mesopotamia in the east. One monetary system. Soldiers paid in coin, taxes collected in coin, markets operating in Roman denominations. The silver denarius, specifically, was the workhorse, the coin that showed up in pockets and markets and hoards from one end of the empire to the other. It worked for centuries, remarkably well, all things considered. But the Roman monetary system carried within it a fragility that would eventually feed into the empire's long decline. When an empire needs more money, what does it do? Tax more. But that causes unrest, and there are limits. Conquer new territories and seize their wealth. But conquest is expensive, and eventually there are no more easy conquests, or it can quietly reduce the precious metal content of each coin. Add a little more bronze to the silver denarius. Reduce the gold in the aureus. This is debasement. The Romans practiced it with increasing desperation through the later centuries. A silver denarius in the early empire was about 90% silver. By the late 3rd century, 5%, sometimes less. The coin still said it was a denarius. It looked like one, more or less. But the merchants and traders who handled thousands of them daily noticed the difference. They always notice. When the money is worth less, prices go up. Wages feel like less. Savings erode. Trust in the currency begins to fray, then snap. When the Western Empire collapsed in the late 5th century, the monetary economy it had sustained collapsed with it. Trade contracted. Cities shrank. Much of Western Europe retreated towards something more local, more agricultural, closer to direct exchange than to anything we'd recognize as a market economy. The great monetary engine wound down. Money didn't disappear, though. It never really does. It changes shape, moves into different forms. Wait. The centuries after Rome's fall are sometimes still called the Dark Ages, though historians have been moving away from that label for decades now. It gives too misleading an impression of total collapse. Life continued, Communities were organized. Art and learning survived in monasteries. People still traded with each other. But economically, it was a time of genuine simplification. Gold coins kept circulating, mainly among the wealthy and for long-distance trade. For most ordinary people, day to day, commerce slid back toward barter or towards systems of obligation and labor that existed largely outside a money economy. A peasant farmer might pay rent as 3 days of work a week on the Lord's fields, or as a portion of the harvest, precise arrangements, binding ones, but not monetary in the way we'd understand the word. The monasteries, interestingly, were among the most sophisticated economic entities of early medieval Europe. They kept careful accounts, managed large agricultural estates, maintained the kind of institutional memory that secular life didn't always preserve. They were, in a quiet way, keeping something alive. And then gradually, across many slow centuries, the monetary economy began stirring again. Trade routes reopened. Towns grew. In northern Italy, something new was taking shape in the counting houses of Genoa and Venice and Florence. The medieval Italian merchants faced a problem that's actually worth understanding in some detail. They were trading across enormous distances. Silk and spices from the east, wool from England and Flanders, grain from Sicily and the Black Sea, metals from the German mines. These trades involved large sums of money, and carrying that money, actual gold or silver, over those distances was genuinely dangerous. Roads weren't reliably safe. Ships were lost. The weight and bulk of metal made large transactions clumsy at best. Out of that specific, practical problem came one of the most consequential financial innovations in history, the bill of exchange. Here is how it worked. A Florentine merchant wants to buy wool from a merchant in London. He doesn't want to ship gold across Europe. Too risky, too expensive. So he visits a Florentine banker, deposits his gold there, and the banker issues a document stating that the holder may collect an equivalent sum from the banker's correspondent in London. The merchant travels to London carrying a piece of paper, presents it, collects payment. No gold has moved. The transaction is complete. Each bill was specific to one deal. It wasn't currency in the modern sense, but it demonstrated something that would change everything. The physical movement of metal wasn't actually necessary for economic exchange. What mattered was the promise, documented and trusted, of payment. The great banking families of the period, the Bardi, the Peruzzi, the Medici, built networks of correspondence across the whole continent. They financed kings and popes and armies. And in doing so, they developed credit at a scale and sophistication that hadn't existed before. The ability to spend money you didn't yet have, backed by the promise of future repayment. Lending at interest is ancient. The Code of Hammurabi, from Babylon around 1750 BCE, specifies interest rates for different types of loans, which suggests the practice goes back well before even that. But the scale of medieval Italian credit was different, integrated into a continent-spanning commercial system in a way that changed the texture of economic life. It also introduced tensions that have never fully resolved. The church condemned lending at interest as usury, money making money by simply sitting there without labor. Many religious thinkers found this genuinely wrong, not just inconvenient, but commerce needed credit. Workarounds were found. The bill of exchange was partly designed to sidestep the appearance of usury. Because exchange rates fluctuated, the banker's profit could be framed as an exchange gain rather than interest. A convenient distinction, perhaps, but a real one in law. Commerce and morality in awkward negotiation. That tension runs through the whole of monetary history and hasn't really ended. While all of this was unfolding in Europe, China had been doing something Europe wouldn't attempt for several more centuries. Paper money. The story starts with the practical inconvenience of carrying coins. By the Tang dynasty, the 7th century CE, China had a thriving commercial economy, and merchants traveling to distant markets had to haul enormous quantities of heavy bronze coins. Difficult, dangerous, slow. So private merchants developed a workaround. Deposit receipts. Leave your coins with a trusted merchant in your home city. Collect a receipt. Carry the receipt to your destination. Exchange it for coins there. These were called flying money. Light, portable, free from the weight of bronze. The Chinese state noticed the potential and moved to take control of it. During the Song dynasty, in the 10th and 11th centuries, the government began issuing official paper notes, printed documents representing a specific value in coin. You could carry a small piece of paper, and it would be accepted as if it were metal. This is, in any meaningful sense, the invention of paper money. The Song notes were backed by coin reserves in theory. For every note, there was coin held to back it, and for a while that worked. But then military pressures increased. The government printed more notes than it had reserves to support. People noticed, they always do, and the notes began losing value. Prices rose. The first major paper money inflation in recorded history unfolded in medieval China, centuries before anything comparable occurred in Europe. Marco Polo visited in the 13th century during the reign of Kublai Khan and wrote about it with evident astonishment. Everyone in the empire accepted these pieces of paper as though they were pure gold. The combination of state authority and printed money was entirely alien to the world he'd come from, where value meant metal, and metal meant coins you could weigh and test. He wasn't wrong to be astonished. It was remarkable. It was also, in the inflationary excess that eventually followed, an early demonstration of what happens when the discipline behind paper money gives way. Europe would learn that lesson eventually, but not yet. Back in Europe, one of the most important developments in monetary history happened not in a grand banking house, but in a relatively ordinary workshop. The goldsmiths. Wealthy individuals needed safe places to keep gold. Keeping it at home was risky. Theft was common, and locks were imperfect. Goldsmiths had strong vaults because they needed them for their own materials and tools. And almost as a side arrangement, they began offering storage to wealthy customers. In return for deposited gold, the customer received a receipt, a piece of paper acknowledging that a specific amount of gold sat in the vault on their behalf. Those receipts began to circulate as payment. Rather than withdrawing gold to pay for something, a merchant would hand over the goldsmith's receipt. The person who received it could collect the gold themselves if they wanted, or simply hold the paper, knowing it was as good as the gold it represented. Merchants passed receipts between themselves. The gold sat still in the vault. The receipts moved. And here is where the goldsmith made a quiet, transformative observation. Most of the deposited gold just sat there. People rarely came for it all at once. The vault was always full of gold that wasn't moving. So the goldsmiths began lending some of it out. If If you have £100 of gold in your vault, and experience tells you that £10 is the most anyone will demand on a given day, why not lend £50 at interest? You can recall loans if needed. You earn on the interest. Your depositors are none the wiser. This is fractional reserve banking in its earliest form. The goldsmith holds receipts for £100, but only £50 of gold is actually there. The rest has been lent into circulation. If everyone came at once and demanded their gold, he couldn't pay. But as long as confidence holds, as long as no one panics, as long as the vault's reputation stays intact, the system works. More than works. It creates money. The £50 lent out enters circulation, gets spent and used and deposited elsewhere, generates activity that wouldn't otherwise exist. New money, created from a promise, and the willingness to trust it. Modern banking still operates this way. When a bank makes a loan today, it is doing something structurally similar to what those goldsmiths were doing 3 or 4 centuries ago, creating money as a promise, backed by confidence. Strange, when you think about it for a moment. Also somehow completely normal, which is perhaps stranger still. By the late 17th century, European banking had developed considerably. In 1694, something happened that still shapes the financial world. The Bank of England was founded. England was at war with France. Wars are expensive, and the government needed money it didn't have. A situation that is, it must be said, almost a constant in European history. A group of merchants and bankers proposed a deal. They would lend the government a large sum in exchange for a royal charter to establish a bank. That bank would be permitted to issue banknotes. Paper money, backed not by a simple gold reserve, but by the government's promise to repay its debts. The government got its loan. The investors got their bank. England got a central bank authorized to issue paper money, backed by the credibility of the state. This was a meaningful move away from commodity money and toward what economists call fiat money. Money whose value comes not from what it's made of, but from the authority and trust behind it. The word fiat is Latin. It means let it be so, which is, if you sit with it, exactly the right phrase. Fiat money is money because the issuing authority declares it to be, because the law says it must be accepted, because habit and necessity and collective agreement reinforce the idea every day until the idea simply becomes reality. Other nations established their own central banks. Paper money gradually displaced metal as the primary medium of everyday exchange. Though metal didn't disappear entirely, not for a long while yet. The 18th century brought revolutions, literal ones, in America, in France. Old orders challenged, some of them destroyed. And with those upheavals came monetary experiments, several of them going badly wrong. During the American Revolutionary War, the Continental Congress had no reliable tax base, no established banking system, no meaningful gold reserves. It needed to fund an army. So it did what governments in difficult positions have done throughout history. It printed money. The continental dollar was issued in large quantities. As more notes entered circulation without sufficient backing, the value fell, steadily at first, then faster. By the war's end, not worth a continental had become common American slang for something utterly worthless. The phrase passed into the language and stayed there for generations. France followed with its own version in the 1790s. The revolutionary government issued the assignat, backed by the value of confiscated church lands. They printed far too many. It collapsed into hyperinflation, prices climbing in a way that stripped the currency of its usefulness. These weren't just economic failures. They left deep marks on national memory. The fear of inflation that follows from these experiences isn't abstract or theoretical. It comes from people watching prices double and double again, savings vanishing, ordinary life becoming unrecognizable. That fear shaped monetary thinking for the following 2 centuries. It fed a lasting, almost visceral attachment to gold. Gold, the history of money, keeps returning here, like a compass, finding north. For most of the 18th and 19th centuries, the dominant monetary system of the developed world was the gold standard. A country's paper currency was directly convertible into a fixed quantity of gold. You could take your banknotes to the central bank and exchange them for gold coins at a guaranteed rate. That fixed relationship gave currency a kind of stability, anchored to something physical, something that couldn't be created from nothing, something with natural limits. Governments couldn't simply print more money whenever they wanted to. They were constrained by how much gold they held in reserve. Creditors liked this considerably. If you lent money, you wanted to be repaid in something that held its value. International traders appreciated it too. Fixed gold values made exchange rates predictable. Country after country joined through the latter half of the 19th century. By the 1870s, most major economies were on it. International trade expanded. Capital moved. The pound sterling dominated global exchange, backed by British financial prestige and the reach of British commerce. It felt stable. It felt natural, permanent, even. And then, in the summer of 1914, it ended. The First World War changed almost everything. When war broke out in August 1914, the major European powers suspended gold convertibility almost immediately. They couldn't fight a modern industrial war and maintain the gold standard at the same time. The scale of spending required was simply incompatible with the discipline the standard demanded. So the presses ran. All the major combatants printed money. For 4 years, the monetary consequences accumulated alongside all the other consequences. After 1918, Britain and France tried to return to the gold standard. They managed it at great cost. Exchange rates were sometimes badly misjudged. Britain returned to its pre-war gold parity in 1925, which many economists at the time, including Keynes, argued overvalued sterling and was squeezing the economy. Unemployment rose. Growth was sluggish. And then, 1929, the stock market crash in October triggered cascading bank failures across the United States. Credit contracted sharply. Businesses failed in waves. Unemployment climbed to levels that had no modern precedent. Here's the thing about the gold standard at that moment. It was designed to provide stability. Instead, it acted like a chain. It prevented governments from expanding the money supply in response to the crisis. It transmitted deflation across borders. The very orthodoxy, meant to protect against irresponsibility, became part of the mechanism of collapse. Country after country abandoned it in the 1930s. Britain left in 1931. The United States, under Roosevelt, suspended domestic gold convertibility in 1933. The classical gold standard was over. the trading floors, the bread lines, the slow queues outside closed bank branches. Those things happened. They shaped everything that came after. As the Second World War drew toward its end, the Allied nations gathered at a resort hotel in Bretton Woods, New Hampshire, July 1944, to design a new international monetary order. Two figures dominated the conference: John Maynard Keynes, representing Britain, and Harry Dexter White of the American Treasury. They had different visions. Keynes had proposed a genuinely new international currency he called the Bancor, designed to balance trade deficits and surpluses globally. White wanted an arrangement that suited American power, which was, not surprisingly, considerably greater than Britain's at that point in history. America had the money. America's position prevailed. The Bretton Woods system anchored everything to the US dollar. The dollar would be fixed to gold at $35 per ounce. All other major currencies would be fixed to the dollar. A gold standard once removed, other currencies weren't directly redeemable for gold, but the dollar was. And since everything else was pegged to the dollar, the whole system was indirectly anchored to gold. The International Monetary Fund and the World Bank were both created at the same conference, designed to oversee the system and help countries in difficulty. For roughly 2 decades, it worked reasonably well. The post-war years brought extraordinary economic growth across Western Europe, Japan, and North America. Trade expanded. Living standards rose. But there was a structural flaw, identified in the 1960s by an American economist named Robert Triffin. It came to be called the Triffin Dilemma. For Bretton Woods to function, the rest of the world needed dollars for international trade, for reserves, to back their own currencies. But the only way for the rest of the world to accumulate more dollars was for the United States to run balance of payments deficits, to spend more abroad than it earned. And if the US ran persistent deficits, dollar holdings in foreign central banks would keep growing. Sooner or later, those banks would ask the obvious question: is there actually enough gold in Fort Knox to back all of this? Through the 1960s, as the US spent heavily on Vietnam and on Lyndon Johnson's Great Society programs, that question grew louder. The doubts accumulated in foreign treasuries and central banks across Europe. In August 1971, Nixon made his announcement. The United States was suspending the convertibility of the dollar into gold. Bretton Woods was over. From that moment, the world's major currencies floated against each other, their values set by market. No gold, no fixed anchor. Just trust, law, and the collective agreement to behave as though the numbers meant something. The anchor lifted, the currencies floating. The float was disorienting at first, actually unsettling for many of the economists and policymakers who had grown up with fixed exchange rates as a fact of life. Values fluctuated. Inflation, which had been building since the late 1960s, accelerated through the 70s. The oil shocks made it considerably worse. The price of oil quadrupled almost overnight in 1973, following an Arab oil embargo. Then it surged again in 1979. Inflation across the developed world climbed into double digits and stayed there. The word that kept appearing in economic commentary was stagflation. High inflation combined with economic stagnation. Rising prices and weak growth at the same time. Older models had suggested this combination shouldn't be possible, which didn't stop it from happening. At the end of the decade, governments came to power in Britain and the United States with a firm commitment to ending it. Thatcher in 1979, Reagan in 1981. Their programs, guided by monetarist economics, particularly the work of Milton Friedman, put inflation control at the center of policy. High interest rates, tight money supply, a willingness to let unemployment rise in order to squeeze inflation out. It worked, slowly, painfully, at the cost of deep recessions in the early 1980s, with unemployment reaching levels not seen since the 1930s in some places. But inflation did come down. By the mid-1980s, something that looked like stability had returned. Central banks accumulated a new kind of authority and prestige. The idea that they should operate independently from political pressure, free to make decisions politicians would rather not make, hardened into orthodoxy. That arrangement held more or less for 3 decades. While all of this was unfolding in the West, other parts of the world were experiencing money's most extreme pathology, hyperinflation. The most studied example is Germany in 1923. After the First World War, Germany carried enormous reparations debts under the Treaty of Versailles. When Germany defaulted on coal and timber deliveries in 1923, France occupied the industrial ruhr region. The German government's response was to print money to pay workers who went on strike in protest, a decision that made a bad situation catastrophic. The money supply expanded, then expanded again, then again. By autumn 1924, prices were doubling every few days. A loaf of bread that cost a few marks in 1921 cost hundreds of billions in a year. People were paid massively, and now they were into a shock, because they were now and still not fully resolved. Each episode has specific causes, but the pattern repeats. When the money supply expands far faster than the economy producing new goods and services, the link between money and value breaks. A piece of paper that was money in the morning becomes just paper by afternoon. Forward now into the late 20th century. The global economy was becoming more interconnected than it had ever been. Communication technology was improving rapidly. Capital was moving across borders with increasing freedom. New financial instruments appeared and multiplied. Derivatives, options, futures, swaps, complex contracts about money and assets, arrangements that let parties hedge risk, speculate on future prices, build financial positions that would have been incomprehensible to a merchant banker of even 50 years earlier. Financial markets grew to extraordinary scale. And for ordinary people, money was changing in a quieter way. Credit cards spread through the 1970s and 1980s. For the first time, consumers could borrow not through a formal loan process, but by presenting a piece of plastic. The friction was gone. Spending beyond current means became easy, almost invisible. ATMs appeared on high streets and bank halls. Electronic funds transfer became standard. Cash began its long, slow decline. Money was becoming increasingly abstract, increasingly digital. And this wasn't entirely new. The goldsmith's receipts had always represented something that wasn't fully there. But the digital era made the abstraction more complete, more pervasive, harder to step back from. When you glance at your bank balance on the screen, you're not looking at something stored in a vault somewhere. You're looking at a record, a number in a database. Your claim on a portion of the bank's assets, a claim that depends on the bank being solvent, the regulatory system functioning, and everyone continuing to behave as if the number is real, which they were. Until, occasionally, they don't. September 2008. It began with houses. In the years before the crisis, the United States had experienced an enormous housing boom. Low interest rates, relaxed lending standards, and a financial innovation, the ability to package mortgage debt into securities and sell it to investors around the world, had combined to create a bubble of extraordinary scale. Millions of Americans took on mortgages they could barely afford. Lenders extended credit with insufficient scrutiny. Complex products built on top of those mortgages, mortgage-backed securities, collateralized debt obligations, distributed the underlying risk throughout the global financial system in ways that weren't always well understood even by the institutions that had created them. That last part is, on reflection, fairly astonishing. When house prices began falling, borrowers defaulted. The securities built on those mortgages collapsed in value. Banks holding them found themselves facing enormous losses. Lehman Brothers filed for bankruptcy in September 2008. The financial system froze. Banks stopped lending to each other. Credit, which the modern economy runs on continuously and invisibly, dried up almost overnight. Stock markets fell sharply. Deep recessions followed across the developed world, the worst since the 1930s in several countries. Governments responded at a scale that had no peacetime precedent. Central banks cut interest rates to near zero. They launched quantitative easing, creating new money electronically, buying financial assets, injecting liquidity into a system that had locked. The Federal Reserve's balance sheet expanded from under $1 trillion before the crisis to several trillion in the years that followed. New money created at a keystroke. The crisis raised questions, urgent, not always well answered, about the relationship between banks and governments, about who bears the cost when the financial system fails, about what the whole elaborate structure is actually for. These weren't new questions, but they were asked with a new rawness in 2008 and the years that followed. And out of that rawness, out of that specific moment, something new appeared. October 2008. A document appeared online in the very weeks the financial crisis was at its worst. 9 pages, written under the pseudonym Satoshi Nakamoto. Bitcoin, a peer-to-peer electronic cash system. He described a currency that would need no bank, no government, no central authority of any kind. A currency existing entirely in digital form, secured by mathematics, maintained across a distributed network of computers around the world. Nobody owns the network. Nobody controls it in the conventional sense. The timing was not accidental. The paper opened with the argument for an electronic payment system that didn't require trust in financial institutions. In a world where that trust had just been severely shaken, where people had watched banks fail and governments scramble and the experts be wrong, this arrived differently than it might have in calmer times. Bitcoin launched in January 2009. It was the first successful implementation of what we now call a cryptocurrency. The underlying technology, the blockchain, works something like this. Every transaction is recorded on a distributed ledger, a chain of data blocks maintained simultaneously across thousands of computers worldwide. No single entity controls it. Adding a new block to the chain requires solving a complex mathematical puzzle. This process, mining, makes the ledger almost impossible to falsify retroactively. To alter a historical transaction, you'd need to redo the computational work for every block added since, which would require more processing power than the entire rest of the network combined. Practically speaking, that's not achievable. The result is a kind of trust that doesn't require trusting any particular person or institution. The mathematics guarantees it, or something close to that. This was genuinely new. Across the whole sweep of monetary history, value had always been anchored either to a physical commodity or to the authority of an institution, a king, a state, a central bank. Bitcoin proposed a third option: algorithmic certainty, mathematical proof in place of institutional credibility. Whether that represents a genuine new chapter in monetary history or an experiment that will eventually be absorbed into the existing system remains honestly unclear. The years since 2009 have brought extraordinary volatility. Price swings that would have seemed impossible in traditional currencies, along with proliferating new cryptocurrencies, regulatory battles in every major economy, and deep disagreement about what these things actually are and what they're for. Still unfolding, still genuinely uncertain. Before we close, there are a few civilizations we pass too quickly. Ancient Mesopotamia, for one. The land between the Tigris and the Euphrates, what is now Iraq, is one of the genuine birthplaces of complex economic life. The Sumerians, who built the first cities there around 5,000 years ago, were extraordinary record keepers. Many of the oldest written documents we have, clay tablets baked and preserved for millennia in dry soil, are economic records, temple receipts, grain accounts, ration lists that tell you exactly who got what and when. The temples of Sumer weren't only religious centers, they were economic engines, accumulating grain from surrounding farmland, storing it in great warehouses, redistributing it to workers and craftsmen and everyone who depended on the temple's organization. The temple was the granary, the bank, the employer, all at once. In these temple economies, grain and silver functioned as units of account, not necessarily as objects physically changing hands in every transaction, but as reference points, standards against which other things were measured. A certain amount of labor equaled a certain weight of silver. A quantity of oil equaled a certain amount of grain. The actual payment might take many forms, but the accounting happened in standardized units. The Code of Hammurabi, the Babylonian legal text from around 1750 BCE, is full of prices. What a day of labor costs. What a boat rental costs. What various offences cost, expressed in weights of silver. These aren't just laws. They're a window into a thoroughly monetized world that's far older than we usually picture when we think about money's origins. 5,000 years of people trying to work out what things are worth. That's a very long project. Egypt is another civilization that deserves a little more time. Ancient Egypt differed from Mesopotamia in ways that shaped its monetary history throughout. The Nile Valley was extraordinarily productive, but geographically concentrated. The state, the pharaoh, his vast administration, was enormously powerful. Private commerce existed, but was more constrained than in the trading cities of Mesopotamia or the Greek world. And Egypt, for most of its 3,000-year history, didn't use coins. This surprises people when they first encounter it. One of the most durable states in human history, monuments that still astonish anyone who sees them, and no coins. Workers on the great building projects, including, presumably, the pyramids, were paid in grain, beer, bread, cloth, and oil. Real goods, distributed according to rank and role, with the state keeping detailed records of who received what. The workers at Deir el-Medina, the village that housed the craftsmen building the royal tombs in the Valley of the Kings, went on strike at least once when their rations arrived late, a detail that makes them feel unexpectedly contemporary. For trade, Egypt used weight-based exchange in gold, silver, and copper. Not coins, weighed quantities, often in rings or bars. The deben was a standard weight of copper. A length of linen might be worth 5 deben. A wooden bed, 2.5. People didn't necessarily hand over copper rings in every transaction. Often they exchanged goods directly. But the deben provided the shared language that made fair comparison possible. This persisted remarkably well for a remarkably long time. It changed only when Alexander the Great swept through the Near East in the late 4th century BCE, and the Greek coinage system came with him. The Ptolemaic dynasty that followed introduced coins, and the market economy they implied gradually took hold. 3,000 years without coins. Perhaps the lesson is that the specific for money takes matters less than what's behind it. The organization, the shared understanding, the willingness to accept the same unit of value. The medieval Islamic world is often underweighted in histories of money that keep a primarily European focus. It shouldn't be. From the 7th century onwards, the Islamic world expanded with extraordinary speed, creating a vast trading zone from Spain in the west to Central Asia and the Indian subcontinent in the east. Merchants could travel thousands of miles within a shared legal and linguistic framework. Arabic was the common language of commerce and scholarship across an area of extraordinary cultural diversity. The Islamic world developed financial instruments that in some respects anticipated later European innovations by centuries. The Suq, sometimes cited as an ancestor of the modern check, was a written order directing a banker to pay a named recipient a specific sum. It let merchants do business across long distances without hauling coin. There's a practical elegance to it that recurs across monetary history. Wherever trade stretches over distance, people find ways to move value without moving metal. Islamic jurisprudence prohibited riba, interest or usury, which shaped the development of finance in complicated and creative ways. Workarounds emerged. The mudaraba, a partnership contract, was one important example. An investor provided capital. A merchant provided expertise and labor. Profits were divided according to a pre-agreed ratio. Losses fell on the investor. Structurally, not so different from a modern equity investment, but framed as participation in a shared venture rather than lending at interest. The gold dinar maintained a remarkable consistency of weight and purity over centuries. That consistency made it trusted well beyond the Islamic world's own boundaries. Merchants in India, in the Baltic, in sub-Saharan Africa, recognized and accepted it, a currency that earned confidence on the far side of the world through sustained institutional reliability over a very long time. Sub-Saharan Africa is another part of this story that tends to be underweighted, and it shouldn't be. West Africa was one of the great sources of gold in the medieval world. The empires of Ghana, Mali, and Songhai controlled vast gold fields and accumulated wealth on a scale that was remarked upon across the Islamic world and beyond. Mansa Musa, ruler of the Mali Empire in the early 14th century, became famous when he made his pilgrimage to Mecca in 1324, traveling with an enormous retinue and distributing gold so freely along the route that he reportedly caused significant inflation in Egypt and other regions he passed through. Contemporary accounts record merchants and officials in Cairo talking about it for years afterwards. His wealth was, by various estimates, extraordinary by any era's standards. Gold dust was the common currency of West African trade, weighed out with precision scales at every transaction. But cowrie shells, imported from the Indian Ocean, circulated as currency across an enormous area of West and Central Africa for centuries. And the story of how that worked is genuinely interesting. Cowries are small, smooth, and glossy, durable, difficult to counterfeit, and crucially, they came from far away, the Maldive Islands primarily, which meant no local ruler could simply collect them from a nearby beach and flood the supply. The natural distance between production and use provided a kind of automatic supply discipline, a trade network built on shells stretching from the Maldives across the Indian Ocean, up the Swahili coast, through the Sahara, across West Africa. By the time Europeans arrived in the 15th century, the cowrie had been the dominant small denomination currency across vast stretches of the continent for hundreds of years. The European slave trade used cowrie shells as one of its exchange media. Traders bought them in the Indian Ocean and used them in West Africa to purchase enslaved people, a fact that sits heavily on the history of this particular currency. The influx of cowries' European trade eventually inflated the supply so severely that it contributed to the collapse of the cowrie monetary system by the 19th century. An ancient currency undermined by a sudden, uncontrolled increase in supply. The same mechanism that drives inflation anyway. Too many units chasing too few goods. Even something as simple as a One more thread from recent history. Something that changed the daily experience of money for ordinary people in the second half of the 20th century. Perhaps more fundamentally than anything since coinage itself. Consumer credit. This began shifting in the early 20th century with higher purchase arrangements. Paying for goods in installments, a significant innovation at the time, allowing working people to own things like sewing machines and furniture that would otherwise be out of use. But the real transformation came later. The Diners Club card appeared in 1950, the first general-purpose charge card accepted at a range of New York restaurants, settled at the end of each month. A novelty at first, used by businessmen who found it convenient not to carry cash for meals. In 1958, Bank of America issued a bank note with fascinating form, made up of hesitant to 60,000 residents as an experiment. It allowed cardholders to carry the balance from month to month, paying interest on what remained. That was the credit card, the one we know. Over the following decades, it spread across the United States and then the world. And as it spread, it normalized something. Spending money you hadn't yet earned stopped being a sign of financial distress and became simply a feature of modern life. By the late 20th century, consumer credit wasn't just widespread, it was structural. Mortgages, car loans, student loans, credit card balances. The modern consumer economy was built on borrowed money to a degree that would have seemed extraordinary to earlier generations. Borrowed money is borrowed time. Credit, used carefully, genuinely helps people build lives, buy homes, absorb unexpected shocks, start things. Used carelessly, it blurs the line between what you actually have and what you merely appear to have, at least for now. Before we arrive at the end, there are three things money has always done, and laying them out clarifies a lot of what we've been through. A medium of exchange, a store of value, a unit of account. As a medium of exchange, it makes trade possible between people who don't both happen to want exactly what the other has. Solves the double coincidence problem. Lets the baker, the blacksmith, the school teacher, and the software engineer all participate in the same economy without needing perfectly aligned desires. As a store of value, it lets you defer consumption, earn now, spend later, save for something, plan. This only works if money holds its value reasonably well over time. Inflation corrodes it. Hyperinflation destroys it. As a unit of account, it provides a shared language of value, a way to compare unlike things, write contracts, keep books. For most of history, the same thing served all three functions at once. Gold managed all three reasonably well. In the modern world, these have quietly separated. In countries experiencing high inflation, people often use local currency for daily transactions because the law requires it. Store savings in dollars or euros because they trust those more, and mentally calculate value in whichever currency feels stable. The functions split, and people route each one to whatever serves it best. Money bends to fit what people actually need from it. That flexibility is part of what makes it so persistent. What runs through all of this, from the Sumerian grain temples to the blockchain, is one thing. Money is trust. It has always been trust. The cowrie shell is money because the community agrees it is. The gold coin is money because the royal stamp says it's been verified. The banknote is money because the government stands behind it. The number in your bank account is money because the bank promises to honor it, and the system promises to back the bank. Remove the trust, and the money becomes what it physically is: a shell, a disc of metal, paper, a number on a screen with nothing behind it. We live our entire economic lives inside a system of shared agreement, a collective arrangement that functions because everyone behaves as though it's real. And in behaving as though it's real, it becomes real. The history of money is also, in this sense, a history of power. Who creates money and who controls it? Who benefits from its creation? Who bears the cost of its failure? In ancient Rome, the emperor's face on every coin was not merely decorative. It was a claim about where all value originated. The church's condemnation of usury was an attempt to regulate who could accumulate wealth and through what means. The founding of the Bank of England was a new partnership between merchant capital and state power. The gold standard was a political choice, favoring creditors over debtors, stability over flexibility. Bitcoin is, among other things, a political argument, a claim that money can exist outside the control of states and banks. Money is never just money, which is why the arguments about it are so often fierce. They're really arguments about something else entirely. The night is deep now. The story has traveled a long way, from the first gestures of sharing around fires, when there wasn't yet a word for what was being exchanged, through the gradual invention of barter and commodity currency and precious metal and coins, through the fall of Rome and the slow rebuilding of trade across centuries, through the brilliance of Italian banking and the quiet revolution that happened in goldsmith workshops, through gold standards and their abandonment, through the Bretton Woods Hotel and the Nixon announcement, through the 2008 crash and the white paper that appeared in its immediate aftermath. All of it connected, one continuous human story about learning, very slowly, with many failures and reversals, to cooperate across distance and difference, to believe in something that isn't quite there, and to make it real by believing. Think of the history of money as a river. Its source is in the first moments of human cooperation, the first time two people looked at what each other had and thought, perhaps we can work something out. That small and ancient moment of exchange. It has been flowing ever since, through abundance and scarcity, past the ruins of collapsed currencies and the gleaming towers of financial centers, under the watchful eyes of priests and emperors and central bankers, through metal and paper and electronic light, still flowing. It will still be flowing when we wake. But for now, the night is quiet. The river runs without us. Breathe. The story knows where it's going, and you are here, at the edge of sleep, held by something older than any currency ever minted. The simple fact of being present, breathing, enough.